Imagine waking up on the first day of every month and seeing money deposited into your bank account while you were sleeping. It sounds like a dream. Many people call this passive income, and one of the most common ways people try to build it is by owning rental properties. But is rental income really passive? And how does one house eventually become enough income to help someone reach financial freedom? Let's find out. Welcome to Early B's personal finance channel, and today we are going to discuss how rental properties build passive income. Let's get started. When most people think about making money, they think about a job. You work for 8 hours. Your employer pays you. If you stop working, the paycheck usually stops too. Passive income is different. Passive income is money that continues to come in after you've already done most of the work to create the investment. Rental properties are one example. You buy a property, prepare it for tenants, find someone to rent it. Then every month the tenant pays rent. That doesn't mean there's no work involved. Properties need repairs, tenants move out, and paperwork still has to be handled. But compared to working hourly for every dollar, rental income can become much less dependent on your daily time. Let's imagine you buy a small rental house. A family rents it for $2,000 each month. Every month the rent comes in, but you don't keep all of it. Some of that money goes toward expenses like property taxes, insurance, maintenance, repairs, mortgage payments, property management, if you hire one. After paying those bills, whatever remains is called cash flow. For example, if the property collects $2,000 in rent and total monthly expenses are $1,600, the remaining $400 is positive cash flow. This amount will vary depending on the property and unexpected costs, but the goal is to own rentals that consistently produce income after expenses. Rental properties can help build wealth in more than one way. The first is cash flow. If your property earns more than it costs to operate, that extra money can be saved, invested, or used to buy another property. The second is appreciation. Over time, a property's value may increase because of local market conditions, neighborhood improvements, or upgrades made by the owner. Property values can also decline, so appreciation is never guaranteed. The third is mortgage paydown. If you finance a property with a loan, part of each mortgage payment reduces the loan balance. Over many years, your ownership share, called equity, can grow as the loan is paid down. In many cases, your tenants are effectively contributing to those mortgage payments through the rent they pay. Imagine your rental property has been performing well for several years. It has generated cash flow. The loan balance has gone down. The property's value has increased. You may now have more equity than when you first bought it. Some investors use that equity, along with savings, to purchase another rental property. Then they repeat the process. Over time, one rental can become two, two can become five, five can become 10. This gradual growth is one reason many long-term investors focus on rental real estate. It usually takes years, not weeks, but consistency can make a big difference. Here's an important truth. Rental income is often described as passive, but it isn't completely hands-off. Roofs need repairs, appliances break, tenants move out, vacancies happen, markets change. Some investors hire professional property managers to handle many day-to-day tasks, which can make the investment feel more passive, but those services also cost money. Successful rental property owners plan for these challenges instead of assuming everything will always go smoothly. Rental properties don't create wealth overnight. They require careful planning, good financial decisions, and patience. But when managed responsibly, they can provide recurring rental income, the potential for long-term appreciation, growing equity through mortgage paydown, and opportunities to expand into additional investments. That's why many experienced investors view rental properties not just as houses, but as income-producing assets. The goal isn't simply to own more real estate. The goal is to own assets that can help support your financial future for years to come. If you're interested in building wealth through real estate, understanding these fundamentals is the first step. This is Early B's personal finance channel. Thanks for watching, and we'll see you in the next video.